Okay, listen up. You're probably tuning into this explainer because you want to make a killing in the markets, right? Look, maybe you're 19 staring at stock charts in your dorm room, or maybe you're just tired of getting average returns while everybody else seems to be getting rich. I totally get it. But as your mentor today, I'm going to give you a little tough love. I'm about to reveal the true, unglamorous, wildly misunderstood secret to making actual money. And spoiler alert, it has absolutely nothing to do with what you see in the movies, and literally everything to do with the math of success. So, can you get rich if you lose 80% of the time? Now, if your gut reaction is no way, that's impossible, well, you're currently operating with a pretty dangerous amateur illusion. See, most beginners think trading is all about finding some magical crystal ball. They think it's this endless hunt for secret entry signals so they can be right and win every single trade. But today, we're going to completely shatter that illusion. Okay, let's dive into this. On one hand, you have the amateur mindset, which is entirely obsessed with predicting the future, right? They want that crystal ball to know exactly when to buy. But the professional? A professional treats trading like a boring, highly profitable business. They really don't care about predicting the future. Instead, they are completely obsessed with pre-planned exits and objective mathematical metrics. Because making money in the markets, it isn't about guessing right. It's a carefully calculated math equation, and the very first variable in that equation, knowing exactly how to get out. And that brings us to the absolute first step in building a professional trading business, establishing what we call the abort exit. Think of it kind of like a car screeching to a halt right before driving off a cliff. It's that exact price point where you just admit, okay, something is wrong with this trade, and you get out to preserve your capital. It is your absolute worst case scenario. And honestly, it must be set in stone before you ever risk a single dime. As the renowned trading coach Van K. Tharp puts it, always have an exit point before you enter into a trade. I really need to hammer home this cardinal rule for you. If you buy a stock or a futures contract and you do not know the exact price where you're going to pull the plug if it goes against you, well, you're not a professional trader. You're just a gambler hoping to get lucky. So, once you have that abort exit figured out, you can define the single most important metric in your business. We call it 1R, which stands for initial risk. This is simply the difference in price between your entry point and your pre-planned worst-case exit stop. Let's say you buy a stock at $40 and your board exit is $30, your 1R is $10 per share. That 1R, that is the foundational unit of absolutely everything we are going to do from here on out. It's the core building block of the whole shebang. Now, once we define that 1R, we actually have to change the entire way we talk about money. Think about it. When we think in terms of raw dollars, we get incredibly emotional, right? Oh man, I lost $500. Or yes, I made $3,000. That emotional language completely clouds your judgment. To evaluate your performance objectively, you have to translate those emotional dollar amounts into mathematical ratios called R multiples. So now every profit and every loss is just a multiple of your initial risk. Now, what's really interesting here is looking at a real example. Say you have a position that shows a profit of $3,456. Sounds nice, right? But to a professional, the actual dollar amount doesn't really matter. What matters is the R multiple, which here is 4.40 R. That just means the reward was over 4 times the initial risk taken. On the flip side, if you have a loss of $1,300, it might be expressed as a negative 1.70 R. A professional tracks a huge sample of these trades to figure out their overall ratio of reward to risk. So, why do we bother tracking all these R multiples? Well, it's to find the holy grail of trading, expectancy. Expectancy is simply the mean or the average R multiple you can expect to make per trade over time. If you just add up all your R multiples and divide by the number of trades, boom, you get this number. It tells you exactly what your system will produce on average over hundreds of trades. It cuts through all the noise of lucky streaks and bad days, and it tells you if you actually have a viable business on your hands. To truly grasp expectancy, we need to completely shift your paradigm about probability. In his workshops, Van Tharp runs this fascinating thing called the marble game. Just imagine a bag filled with marbles, okay? Pulling a marble out of that bag represents taking a randomly generated trade from your system. This analogy is literally going to prove to you that you do not need to be right all the time to make an absolute fortune. And this brilliantly illustrates exactly what I mean. Imagine the breakdown of the specific marble bag. 20% of the time, you pull a massive 10R winner. You literally make 10 times your risk. Awesome! But look at the rest of it. 70% of the time, you pull a standard 1R loser, and 10% of the time, you pull a painful 5R loser. Think about that for a second. You are losing money on 80% of your trades. Most amateurs would look at this system, get frustrated after maybe 5 straight losses, and just quit. But let's look at the actual math, not the emotion. If you calculate the expectancy of that bag of marbles, all those big winners minus all those frequent losers, the average outcome per poll is actually a positive 0.8R. That's right. Despite being wrong and losing money 80% of the time, the expectancy is wildly positive. Every single time you reach into that bag, mathematically, you are expected to make 0.8 times whatever you risked. It is a highly profitable, winning system. Let's move to and see how this builds your wealth over time. Say you execute 80 trades in a year using this system. With an expectancy of 0.8R, you're going to generate an average return of 64R for the year. To put that into perspective, if you structure your business so that 1R equals 1% of your total account equity, those 80 trades just put you up over 60% for the year. Think about that. You lost 80% of the time, you were barely ever right, and yet you absolutely crushed the market. So, this brings us to a massive pivot. If the secret isn't predicting the market, and if you can literally lose 80% of the time and still pull in a 60% annual return, well, what's the missing link? What actually determines if you meet your financial goals, or if you just end up broke like most beginners? The answer is position sizing. This is the specific part of your system that dictates exactly how much to trade. It's basically your ultimate shield. It ensures you survive a string of losing trades so you can actually stay in the game long enough to meet your financial objectives. I can't stress this enough. Position sizing, not your fancy entry signal, not those complicated chart patterns, is the absolute priority. So the crucial point is, without position sizing, math will eventually destroy you. In Tharp's workshops, he runs the simulation where he has a participant, let's call him Bill, pull marbles out of the bag until he hits a winning streak. Naturally, Bill pulls a long string of losers first. And because the audience didn't use proper position sizing, many of their simulated accounts literally go bankrupt. When asked why, they blame Bill for pulling bad marbles. They blame bad luck. But random streaks of bad luck are inevitable. It wasn't Bill's fault. It was their complete lack of position sizing that wiped them out. Listen to this rule closely. You could have the world's best system, but you still could go bankrupt if you risked 100% on one of the losing trades. Let that sink in, my young friend. Going bankrupt is not the market's fault. It is a choice. It's a choice caused by poor position sizing. If you risk way too much of your capital on a single trade, even a system with a massive positive expectancy is eventually going to ruin you when you hit a normal, statistically guaranteed losing streak. All right, let's summarize this math of success into a professional playbook. Step 1, always set an abort exit to define your initial risk, your 1R. Step 2, stop crying over dollar amounts and track all your results purely as R multiples. Step 3, use those multiples to verify that your system actually has a positive expectancy. And step 4, use strict position sizing to ensure you survive the losers and compound the winners. That right there is the true math. We've covered a lot of ground today, and I really hope I've shattered some of those amateur illusions you might have walked in with. Real trading isn't about being a psychic. It's about being a disciplined mathematician managing risk. So I'm going to leave you with this one provocative question. Are you going to keep chasing magic entry signals and gambling your money away? Or are you finally ready to master position sizing and start running a true, wildly profitable trading business? The choice is entirely yours.